Well. Welcome back, everybody. It's good to be back from vacation. The markets are green again. We finally escaped the vacation red. The shutdown is coming to an end. I just got a whole brand new cup of coffee. And, folks, the market is finally moving nicely. Look at this. No dump at the morning, straight up. We can all just go right back to normal and just be happy. It's great. Now, obviously, we've got some cabbies coming up on reopening. The Bureau of Labor Statistics won't have all of the data ready for us because they'll have both, CPI data. They'll have information on inflation. We'll have all of this. The problem is, when are we actually going to get that? To be determined. But we'll see. Now, we have some expectations we were talking about in the course live this morning. Boy, we were busy in the course member live stream this morning. We did some great analysis, and it's something where these catalysts, they're going to be out within the next, call it maybe 2 to 3 weeks here if we reopen this week here. So those could confirm a soft landing. That's what we've been waiting for. Or they could tell us that things are worsening. And so that's kind of that teeter-totter situation we're in. So I'm very curious to see what the data shows. But until that data comes out, it seems like markets are going to be very, very happy, especially in a bounce today from what we had on Thursday and Friday. Thursday and Friday, of course, were the days I was on vacation. So, naturally, buy the dip opportunity for right when Kevin comes back. Here we are, and the question now is: are we going to be able to make it back into those 630s on the Qs? That's the goal here. Now, let's go jump into some of the headlines this morning. One thing I see is a lot of talk, obviously, about the shutdown ending. Okay, that's going to be old news. And if we look at some other information, we've got the Nord Stream investigation that's splintering Europe over Ukraine. German detectives have spent 3 years building the case, and a Ukrainian veteran could soon be in the dock. Ooh. Yeah, I mean, this was always the belief that, this was not... So many, the way this was marketed by the mainstream media was, it's Russia's self-sabotage. And people are like, nah, man, come on. The Ukrainians did this. And so that's at least what the stories are suggesting now. Who knows anymore what to believe? But what else do we have? Really, I mean, in the way of news, when we saw the visa and the rebate issue with potentially reward cards, not, I think, that big of news. We've got Trump's tariff rebate contradiction. We'll take a look at this. Obviously, the stimmy news this weekend was very exciting. Whether or not that actually happens will be very interesting because, Trump is kind of known for saying things that are popular, and then whether or not there's a follow through of that, well, that's a totally separate issue. So President Trump has a big tariff problem. His border taxes are raising prices on tariff goods. Unpopular with voters, and the Supreme Court might rule that the tariffs are illegal. His latest response promised $2,000. This was his Hail Mary past Sunday as he declared on social media that people against tariffs are fools, right? He went on to promise various benefits from tariffs, including taking in trillions. Not taking in trillions at this point, but okay. And that we'll soon be able to pay down the nation's debt, right? This is how we keep getting sold the idea of tariffs is like, oh, well, we'll pay our debt down by doing this. But then the concern is, okay, but how much are Americans actually paying of this? So it's really just like a sly tax. And then if you spend it all on a dividend stimulus check, then you don't have anything left to pay down the debt. This is a teaching moment for a high school logic class. Start with the contradiction that Trump can both pay the tariff rebate and pay down the debt. Well, there you go. Exactly. I mean, but that's obvious. That I even said that in my video yesterday. I'm like, you're gonna have to kind of pick one here. Annual budget deficit is 1.8 trillion, even with tariff revenue. So paying a rebate would add to the nation's debt, not reduce it. Right. Because if theoretically they're all being earmarked towards paying down the debt, anything you are now doing to increase spending is bad. Okay. Trump claim of revenue benefits from tariffs also belies what his Solicitor General told the Supreme Court. In arguing that tariffs aren't really taxes, they're mainly a tool of foreign policy, Mr. Sawyer said these tariffs, these policies, it's clear that these policies are most effective if nobody ever pays the tariff. What? If it never raises a dime of revenue, they're most effective use of these because, okay, so basically because they're a negotiation tool. So, I mean, they're trying to win their court argument in doing so. Obviously, it's a little bit of like a shot in the foot because it's like, yeah, you know, our goal is actually that nobody pays the dime, that they just like roll over when we negotiate. All right. I mean, okay, I get the argument. That doesn't really jive with the idea of paying stimmies, but okay. So let's see, then we've got, but wait, if tariffs are most effective if nobody pays them, then how are they going to raise revenue? The truth is tariffs are taxes, but Sawyer didn't want to admit that. Of course not, because taxes can only be levied by Congress. Yes. Mr. Trump is essentially promising to repay Americans $2,000 of border taxes they're paying in higher prices. But if tariffs are a free lunch and their benefits abound, why offer a rebate? Shouldn't voters be thrilled about tariffs even without a rebate? Nope. Trump also, you know, in fairness, wants to win the midterms, right? He wants the party to control midterms and not lose the way they just lost in this last election. Trump is trying to exploit the fact that tariff impact is dispersed across the economy, so consumers have a hard time sorting out how much these taxes contribute to higher prices, right? Trump is trying to dull the public tariff pain with direct payments that he can take credit for. It's a new version of the age-old redistribution game. Yeah. So, you know, it's all going to be a debt driver, right? That's the issue, is you just end up driving debt. Like, especially if the tariffs are declared illegal, you know, then you got saddled with no income and all the debt. Democrats do this all the time with child tax credits and other favors to special interest groups. Absolutely true. We've advised Mr. Trump from the beginning that tariffs would do economic harm, and so they are. They're doing political damage to the GOP, which is why he's flowing the rebates. Interesting. Wall Street Journal is going as far as saying here, like, these tariffs are so unpopular now that they're causing political damage. Mr. President, it's never a good idea to call voters fools. I mean, yeah, it's a good point. I wonder what some of the top comments are on the Journal. So let's go. Yeah, we'll go to the most liked. Let's see. Trump threatened Amazon with retribution if they went forward with plans to explicitly tell their customers how much tariffs contributed to the cost of orders. That's right. Yeah, I remember that. Now I do. I did forget about that. But that's right. Amazon was going to put up a label and be like, hey, this is how much the extra the tariffs are costing you. Wow. You don't fix one problem by causing another. SCOTUS must declare these tariffs illegal because they are. They're a tax on the American consumer. Wow. I support tariffs because the U.S. is getting ripped off. You know, people always say that, but I don't think people realize how much we benefit from deflation. You know, people make this rip-off argument all the time, but I'm like, bro, like, if we all imported Chinese cars and we had like really sick Chinese cars for $15,000 because let's say there were no tariffs on them, instead of you paying $50,000 for a car, you'd be paying $15,000 for a car. Is that you as a consumer getting ripped off? No, you're getting a great freaking deal, bro. You're not getting ripped off. You're benefiting from deflation. Now, who feels ripped off? Well, the United Auto Workers, the unions that are working in American factories. But dude, you've got 120 million people who own cars in America, or families, households that own cars in America. You got, what, 300,000 UAWs? United Auto Workers? Come on, man. Like, it's... So what else do we have here? Like buying votes with taxpayer money. Another suggestion, it's never a good idea to call voters fools, blah, blah, blah. Blah, 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 blah. All right, cool. All right, interesting. So a little bit more here. What else have we? All right, let's go. Let's go pop up some news here. All right, and what are y'all saying here? Let's see here. Somebody's talking about all-in pod. What's on the all-in pod? What are they yapping about? Stimulus checks, inflation, cheaper imports ease inflation. Suddenly the Fed has to start cutting rates. Right? Yes, exactly. So if we import deflation, like what China is suffering, deflation, rates can come down, which is great, right? That would be a wonderful thing. So it'd be great, absolutely great. All right, so let's go see. Yeah, the 10-2 yield curve has been sneaking up a little bit, especially now that the government is expected to reopen, mostly because you'll expect to see more government spending again, which is understandable. But I mean, this has been so range bound. I don't know that this is really that big of a deal just because it is so range bound. There's no particular spike there to be really nervous about. Fed Muslim sees economic rebound in first quarter. Yeah, and I think we had daily talk this morning as well. Let's see what they're talking about. Okay, and let me also get Daily's comments up. So this guy says Muslim expects the U.S. economy to bounce back strongly next year. Well, that's exciting. We're going to get, I think, a substantial rebound in the first quarter, citing fiscal support and the impact of rate cuts and deregulation. Okay. It's very important that we tread with caution because I believe there's limited room for further reductions without monetary policy becoming overly accommodative. Wow. Basically arguing that we've already done enough here. Let's go to. Let me see if Daily's saying anything. Let's see. Need to lean against inflation. Tread with caution here. Labor markets is having cooled in an orderly way. Companies tell me that uncertainty has plateaued. And then let's look at Daily too. I'm actually going to write down some of this. Let's see here. Daily. Fed. Let's see here. So Daily from the Fed says tariff effects contained to goods. Okay, that's a key factor, right? They are keenly watching for spillover effects, right? That's why they talk about this sort of containment of inflation is critical for the Fed. Tariff effects, largely confined, daily, price expectations, anchored, experiencing a negative demand shock. And saying negative demand shock. Our schedules haven't aligned in a while. Wanted to thank you. You really helped me leverage the pandemic. Got a mortgage, a new job, new woman, literal life change. Wow, congratulations. I'm really happy for you. And thank you for coming back to say that. Really appreciate that. Good for you. I'm very happy for you. So, experiencing a negative demand shock daily. Inflation has been pretty contained so far in goods. That's good. Financial conditions. If firms were scrambling to find workers, wages would rise. Yeah. I mean, that is true. If firms were struggling to find workers, wages would rise, and they're not right now. So we know there's supply. Supply of workers exists. Okay. Then we've got not expecting to see inflation from wages. I agree. Totally agree with that. So then we have, it's always interesting commentary here from the Fed. Definitely in low fire, low hiring. Hey, can't take eyes off inflation. And then, of course, this guy, Moz Salem, whatever. This guy, here's some other comments from him, says higher income households consuming from wealth effect. Right, this is the danger of, by the way, any market decline. Danger of market decline is people stop spending who have been supporting the eco, right? Then you have rate cuts were to provide insurance for the labor market, okay? Rate cuts were insurance for labor market. Labor market is cooled in an orderly way. That's a weird thing to say. Limited room for more cuts, and then argues that, we see a big rebound in Q1. Q1 rebound from rate cuts, deregulation, and fiscal spending. Yeah, actually, that somewhat aligns with this yield hike argument. Aligns with the yield hike argument this weekend. Let me go pull that up. Let's see here. Okay. So this weekend, I saw, who was it? Was it Morgan Stanley? I don't think so. It may have been this one, consumer stock positioning. One of these. Okay, I have it saved. It's just one of these documents, and I think it's really interesting to see. Was it Payne Ahead? It may have been Payne Ahead. Academy Sec. Hike. Okay, no, maybe not. What about this one? Dang. See, that's the downside of when I do this on my iPad. It doesn't necessarily always sync over. Bummer. But that's okay. I think I can find it because it was yesterday. Yesterday, one of the institutions was yapping about it. So I will find it. November 9. Who was... I thought it was Goldman, honestly. SAT. Consumer positioning. I'm pretty sure that was it. Well, let's go look at it together. Let's go see what we have. So, debate around the health of the consumer, government reopen, consumer discretionary was the most net sold last week. Yeah, no kidding. Yeah, this was crazy. Lower than Q2, I put this in here, Goldman Sachs, for their private investors. But this is not where they talked about hikes. Who did it? I want to know. Who would dare say it? Was it Morgan Stanley? Maybe. So Morgan Stanley, they talked... let's see here. Hike. I'll just look. Nope, not them. Darn. Meet Kevin. Can't find the document that he's looking for. I will find it. So just, it aligns so well with what we want to cover here, which is this talk about this rebound maybe in Q1. Was it DB? I don't think so. Oh well. Nope. Oh well, I will find it eventually. All right. So, how's the market doing in the meantime? Let's go take a peek. Score sheet. All right. So, we've got Qs are almost up a full 2. Nvidia's up 4.5% right now, which is remarkable. And then you've got Elf, Dead Cat bouncing. Meta's up almost 2. And then let's see what Sarah's got for us.
All the big names up rather sharply this morning. Again, Alphabet, so interesting to see that stock up 51% for the year. A year ago this time,
Gemini's freaking kicking butt.
Well, is their monopoly in search at Alphabet, Google, going to be challenged by the likes of ChatGPT and others? And yet,
right, it'll take a long time.
Former of sort of that group, without a doubt.
You know why? Because I feel like the narrative has changed the winners are going to be those with the enterprise software business. Yep. And Google really Alphabet has a strong hold in that versus, say, Meta, which hasn't performed well post-earnings. If the prize here is enterprise business shifting to AI, Alphabet's there.
And
right?
Gemini is there. Obviously, they...
Not just Gemini, but also Google Workspace.
Stay in those multiples, and they have to go out and buy growth. So I think that's driving a lot of the mega deals, which you see in the deal value. I think what it's starting to do, though, is work its way down to the private capital markets, where you have a backup of deals given the low level of activity there.
So that's adding to, I mean, when we talk to corporates, to leaders, to CEOs, they say they just have more confidence due to the regulatory environment. It's much easier and at least not getting worse, I think is what Ken Griffin said. So the private capital aspect adds to that to sort of amplify the M&A that we're seeing.
I think that's true. I think we are in an administration that is much more M&A friendly here in the U.S. And I think the other thing you're seeing is, you know, in the private equity world, in the private capital markets, the high quality businesses, the A assets or the A plus assets, those have traded just fine over the last 3 or 4 years.
All right, here we go. It was this one. Barely off record highs, but let's see here. Lack of official data. Let's quickly run a few things. Okay, so we've got Bitcoin trading sideways. We've got retail dip buying. Retail stepped in by the dip. Okay, the pivot on tariffs, we saw that. Okay, where was volatility? Let's see here. Sentiment. There are 2 things I looked at on Friday's consumer confidence. Lol. And just nice little jade they're throwing on this. Republicans are still more positive than they were in April. Independents are below. That seems worth mentioning. Meshes with what we've seen on social. That's fine. Okay. Twitter inflation. Okay. This is talk about... that's right. Okay, so when I was reading this, Academy Securities is suggesting that the Fed was obviously really late over here with responding to inflation, and true inflation should have guided that. And what they're basically saying is, hey, we should be careful about a potential increase in inflation here, because if we do end up getting inflation over here, they make the argument here. This is why so many people have been pounding the table with alternative measures of inflation. True inflation was way ahead of spotting inflation when the Fed actually continued with QE. We were doing QE even as we were discussing possible hikes. True, that was just sort of like historically looking at it. Trueflation is now creeping back above 2.5. CPI coming down due to it finally capturing rent declines, but we know that's super lagging. If you're worried about inflation going back up, trueflation seems to be reflecting that possibility. Okay. Let's see here. Inflation may have influenced the last election. That brings us to bonds. Let's see. Layoff announcements last week save treasuries. Right. That's the play on treasuries. If the labor market falls, treasuries do well. Been very comfortable with rate cuts and longer dated yields for now, but I think the next move is to higher yields. Found it. The Fed will not cut because of Challenger. I agree. ADP, I'm just disappointed that they don't break down here how concentrated ADP was. No mention of concentration. You know, West Coast concentration here. Or layoff plans, right? That's also important. So we'll say that. Or layoff plans. Some concern that inflation is very stubborn here. Well, tariffs don't help. While the administration will not allow tends to get out of control, 4.3 seems like a near short-term target. Rising yields also fit my concerns about risk parity. While generally I'm comfortable with credit spreads, I could see credit spreads going wider rather than tighter, but also yields on the 10 up, fine. Okay, what else? Let's see here. Potential pain seems real. What is this? A potential, and they kind of write like AI in here in a funny way. We didn't even discuss many signs that the deal with China, much celebrated and rewarded by the market, doesn't seem to be good. Yeah, that's also true. Like, this deal with China is like just a minor rollback framework. Doesn't really provide much other color on that though, but I agree with that. So I think really the point here by Academy Securities is watch Trueflation. And what's Trueflation doing? Well, let's just go look at a recent chart of Trueflation. I mean, they have one here, but I'm going to go get my own too. Trueflation. Let's see what they say. So let's see, Trueflation chart. All right. Let's see here. Okay. So this is basically what they're arguing, is when you look at this Trueflation index, we hit our lows in April, but now we've been on this upward trajectory. Now, in fairness, we're still lower than where we were before liberation. But that uptrend is, I think, why he's arguing you could see this potential for hikes if Trueflation keeps moving up, which is what the Fed was blind to last time. And I think that's why you're getting this Fed guy saying, hey, we should wait for Q1. Yeah, and we're only pricing in a 62.7% chance of a cut right now. Oh, very interesting. All right, let's go back over here.
Understand how it'll work procedurally, because apparently any senator can throw a wrench in the works. And there certainly are a number of senators that are against this deal.
Yeah, but maybe just the volume of flights canceled was enough to convince them to cave or come to the table or whatever this deal actually ends up looking at like. All right, some of the single stocks that we're watching at this hour. Health insurers on this very same news. Centene, Oscar, they're falling. Lawmakers are moving closer to ending the shutdown without a health care extension, but there was some reporting that maybe being promised to the Democrats is to revisit the health care insurance later in the year.
Shares of Medicare tumbling after Novo Nordisk pulled.
The larger engines that go into those machines. So there is more supply coming into the market now. And so we're bringing these machines to market, and there's a huge supply deficit.
Is it a new product for you then? Or I mean, is it similar to just having what we know very well and just a lot more of them?
That's exactly it. I mean, it's, generators are generators, right? So this is just a much larger version of the same thing we've been making for a long time.
Does it shift your production facility location?
So we're global, right?
Yeah.
So and the demand is global as well. So we've just shipped some sites out in Australia. So we've got a lot of this is going to happen.
Boring. I'm also noticing right now, take a look at this. Meta's rolling just a little bit, and I want to see what some of the other Mag 7s are doing. Amazon's also bleeding a bit on the day. Tesla's actually still doing well. Look at that nice bounce. 433.99. That's almost a perfect bounce right there. It's one of our favorite lines. How's Google doing on the day? Google's pretty stable. Okay, so a little bit mixed. What about Microsoft? Because that'll drag your Qs down if they all start slowly coming red. All right, let's go see what else. What other commentary is out there? So we saw the Fed commentary. We've got U.S. October consumer goods inflation slows in open brand CPI data. For the first time in 3 months, reflecting a slight pickup in merchant discounting, according to Open Brand. Well, that's a nice little counter offer, or counter. But we don't really even know who this company is. Okay, so what do we got over here? Nuclear arms race is back. Reasons to be bearish about China's rise. Let's see here. Let's see here. Oh, Tom donates $20 to say I have $3,300 a month to invest in the market with nothing started yet in a taxable brokerage. Well, I mean, I can't give anyone personalized advice. We know that, but we appreciate your donation. But, you gotta, I think in this environment, everybody has to look at their own income, and you have to ask yourself, how stable are you? You say you have $3,300, but this is why you can't give personalized advice, because it's like, dude, like, is that $3,300 after taxes or before taxes? How stable is that income? Maybe you have really unstable income. How secure is your job? How strong is your ability to get a new job if you were to lose your job? See, like, what happens? You invest at all-time highs, then you get fired, then the stock market falls. Now you got nothing. So like, investing is great when the price goes down and you're not going to go bankrupt, right? That's really important. So much of that is predicated on your personal situation. Now, I know a lot of people like, just keep it simple, buy the Qs. If you're going to buy the Qs, QQQM, by the way, is the way to go. Just sort of like big tip for everybody. It's basically the same index, tiny little differences, but the fees are way lower. So if you compare the fees of QQQM to QQQ, you save money. And that's because they don't market QQQM, but they do market the Qs on TV and stuff, so they got to kind of pay for that. It's actually kind of a brilliant strategy by them. Trump threatens to sue BBC for $1 billion over Jan 6 edit. Yeah, I saw that. Maybe we'll talk about that. That is quite interesting. Sarkozy's out of jail after 3 weeks as he's waiting for his appeal. Oh, well, they let him out. Interesting. Okay. Let's see what's going on over here. So this is 17 years after credit rating agencies started in the financial crisis. Rating shopping is in focus again. For the first time around, large established rating agencies competing to find finite pools of debt gave out inflated stamps of approval to risky assets. Buyers of the assets were falsely left with the impression that subprime credit they were holding was as safe as it got. Right, but this is the thing. Smaller specialist providers such as Morningstar, Kroll, HR Ratings have seized the market by offering private capital groups a chance to shop around. Sudden bankruptcies at first brands of Tricolor have created some nervousness. Right. Private credit ratings are not, these letters are not publicly disclosed, and they're skyrocketing. I mean, yeah, this is going to be part of like every cycle. Is, these rating agencies saying everything's fine when it's really not, because the assumptions, like the thing is, the incentives are so broken because, like, hey, if you want to make money as a rating agency, you got to win the business. So it's kind of like, yeah, pay us. We'll make sure it's all good, and then you get the deal. So I think the ratings are almost never worth the paper they're written on, because the bias is, to get the contract, to get the ability to go rate. Okay, this is, let's see here. There's a chart on election odds for Trump. It's fine. We could look at that in just a moment. Let's go. What does Politico got? Senate is advancing their plan for ending the shutdown. That's great. We're seeing the Trump threat. Okay. Let's see here. Let's go listen to here for a moment.
By the way, they haven't been proven yet. There were charges that 2 major league pitchers manipulated their performance in order to win on specific sports bets.
Insane. What is this? Oh, that's interesting. Oh, wait, that actually is interesting. So, wait, I guess if you were playing in the game, you could, like, tank or, like, fall on purpose and then make a bunch of money on the sport bet. Oh, that's crazy.
Great example, and it's one that got a lot of publicity. I think it shows a few things. One, these markets are very transparent, right? folks picked up on that very, very quickly because the markets are watched closely. In the Major League Baseball case that I just discussed, analytics apparently caught some of the bets as being anomalous, and it was elevated up. But I think, you know, when I look at different markets, right, I was a federal prosecutor for about 10 years, the head of enforcement at the CFTC. Every asset class has the same risks, whether you're talking equity markets, sports markets, crypto.
Oh, here. It looks like, I guess, Trump is posting again on Truth Social about shutdown is over, and also now potentially checks, talking about how there's enough money for checks. Okay. Air traffic controllers. We got an air traffic controller post here. Let's see here. Air traffic controllers must get back to work now. Otherwise you get docked. I will be recommending bonus of $10,000 per person. If you don't take time off because you're a patriot. Report to work immediately. Okay. But there's supposed to be also something here on the $2,000 checks that there's enough money Okay, yeah. Apparently it's Trump says tariff revenue will fund $2,000 payments and cut the national debt. Trump vows to use tariff income surplus to pay down the U.S. debt. Right. Well, that's the criticism that they keep getting. Is that, oh, you're not actually going to be able to do both. All money left over from the $2,000 payments will be used to substantially pay down the debt. He's doubling down on the checks. He's got to get his votes. Interesting. All right. So, let's see here. What else do we have?
CEO is going to say carne asada in their earnings call feels kind of crazy. What do you do just about like the very large risk and very, gambling aspects that there are to some of these prediction markets?
Well, you have to. It starts with having awareness and strong policies and procedures. And then, there are enforcement cases, right? Now, I would bet after, no pun intended, after these recent indictments that have come down, it has raised a lot of awareness about the risks of participating, in these markets. And so anytime that there is an enforcement case or an indictment, as a prosecutor and a regulator, you are thinking not only about the individual case, although that is your biggest concern, but also the deterrent value of the matter. So as you see problems, and if there are cases, if the facts and circumstances support that, I think that will deter misconduct.
But you're not making, it's important to point out, you're not really making a moral argument about gambling in your piece.
No, the point of the piece from my background is I've looked at markets.
Okay, this is him more just complaining about how those things could be rigged. Okay, so let's see if we can find it, because there's nothing on Axios left about the checks, at least anything that's new. And Politico doesn't have anything new either. It's just Trump's latest reiteration here. Schumer is no longer effective. People are pissed. Okay, well, politicians being pissed is not the greatest surprise. Okay. Let's see. I always like these little roundups. This one looks like it's from a USA Today affiliate. Let's see if we can see. Is Trump issuing $2,000 checks? Here's what we know. So we know we're talking about trillions of dollars. The dividend will be paid. However, it did not include details. All right, we already know that. Not including high-income people. No additional information on that. The problem with this is I don't think it's being, like, I don't know, how do you put it? I don't think there's really much coordination between Trump and his team because, you know, Bessent yesterday was trying to walk back the stimmy check idea. And now Donald Trump is reiterating it. So it just feels a little like rogue, if you will. Bessent, dividend. Let's go see if we can find that video clip. Yeah, already doing this one. Oh, hold on a sec. Let's do this. Here we go.
You know, it could, the $2,000 dividend could come in lots of forms, in lots of ways, George. You know, it could be just the tax decreases that we are seeing on the president's agenda. You know, no tax on tips, no tax on overtime, no tax on Social Security, deductibility of auto loans. So, you know, those are substantial deductions that, you know, are being financed in the tax bill.
Right. So this suggests some lack of consistency within the very Trump administration that would otherwise be bringing these checks. I thought that was very interesting. And then now Donald Trump reiterating the checks. So kind of interesting. Of course, the Journal this morning, they're like, we can't pay down the debt and do stimulus checks. There's not enough money. Somebody says Bessent sounds like he's holding back tears. Oh, no. Okay. All right. These are, what do we have here? Who showed up? Democrat vote wins. Let's see. Democrat margins. Other minority communities also tilted back towards the Democrats in this last election here. In one ward in South Patterson, which has the second largest Arab population in the country, voters shifted 56 points to the left. People just didn't want Harris, huh? Both counties have large Hispanic populations that voted for Trump previously, and they shifted to the left. Younger voters are drifting back. So Hispanic, Arab, and younger so far. Two other states offered further evidence. Pennsylvanians were voting for judges at the highest counts. Georgians for members of the state public utilities regulator. Turnout was predictably lower than in the presidential election. But both delivered landslides for Democrats, sharply improving their 2024 margins. Yeah, it's not going to be good for midterms. And I think that this is exactly why you're getting so much of a push on the checks. Because they see like all of the margins that they had against Kamala are starting, and then went to Donnie, are starting to flip. Yeah, very interesting. Okay. Let's see what the information has. The information, Anthropic projects cost advantage over OpenAI. OpenAI has no cost discipline. We know that. Experts cast down on a flying roadster, whatever. Tesla shareholders divided over XAI investment. Well, good. Leave the company separate. Yeah, the guy who was doing the Cybertruck, one of the Cybertruck guys left this weekend. I didn't know two people left. Yeah, I saw this guy, the Cybertruck guy, 8-year Tesla veteran. I saw him leave. Another one for the Model Y left. Yeah, and there was no other information on that for Tesla. All right, well, that's boring. All right, 10-2 curve, 53. Okay. Let's go back in over here.
To pass, and that could also prove to be some trouble in the House, because although the Senate advanced this on a procedural vote, it still needs to be up for debate in the Senate when they convene shortly and then pass a final floor vote. Any one senator could tie up that process, but we are widely expecting that this legislation will advance out of that.
Oh, well, yeah, what's going on over here? Look at this. We sort of just like peeked out there, didn't we? Look at that. Wow. Why did we just get this? So, a little bit of a rollover is right. And you've got, yeah, Amazon keeps bleeding. You see that. Microsoft now bleeding. How's Apple doing today? Bitcoin back under 105. APL slowly bleeding. The consumer plays are just wrecked. You know, whether it's... I mean, Six Flags just gotten smoked here. Adobe triple bounce has gone nowhere. Starbucks ain't working. Just looking at more consumer names here. Restoration Hardware, Dave & Buster's. Wow. Very interesting. Reddit, Coin. Those are robotic plays. I guess I might as well get rid of this one. This is one of the Trump SPACs. Yeah, wow. What a surprise. Huh.
They're covering the apparent end, or the drawdown, I guess, of the shutdown for us out of Washington, D.C. Coming up tomorrow, Joanne Feeney of Advisors Capital joins us, as well as Victoria Fernandez of Crossmark, plus the CEO of DWS Group Americas. This is Bloomberg Open Interest.
Okay. Yeah, there's also a lot of talk this weekend about, you know, freezing private jet travel. Let me see here. So, let's take a peek. If we go... Where was it? Katie Porter, this right here. So, I think, you know, there are these like community notes where people are like, oh, you know, private jets can't get canceled because, you know, they don't have to use ATC services. This isn't true. If you want to fly a jet in Class A airspace, you are required to use air traffic control and file a flight plan. So the FAA absolutely can freeze private aviation. And that's exactly what now you're seeing with these, you know, the private jet travel getting limited at these larger airports, which usually, honestly, they don't really want to go to these larger airports anyway, because it's really expensive. FAA prohibits most private jets at 12 major airports amid staffing problems. Let's see here. FAA on Monday will effectively prohibit business aviation at dozens of major U.S. airports, adding to flight restrictions for commercial air traffic. So business aviation operators have to have the understanding of these. Okay, what did they say? So most business jet operators don't use the busiest commercial airports. This is true, by the way. Like, you want to avoid these because they're ridiculously expensive to go land at. You'd think it'd be cheaper to go to these big airports, but it's not. It's insane what they charge. Yeah, but I mean, this is not a surprise. Like, if you're going to see pain for some of the airlines, you may as well see them for everyone, right? So, very interesting. CB24, you got to send us your pictures and score footage and the photos. Like, that's what you got to do. Send them over. Like, I'd love to look at the real estate stuff, but I need pictures. Otherwise, I can't react to anything. And why?
It's because that's why.
So, that's interesting. Trump has run out of taco. That's funny. I mean, hey, more tacos, good. So far, taco's been fantastic. All right, let's see if the Journal has anything else. Not really. It's a little quiet. A little quiet today. And we could talk about this. The Trump suit. Oh, those look cool, those shoes. What was that? And what's going on? Yeah, Qs are still bleeding. Look at that. Odd dump here, huh? Look at that. Like, who's selling? Like, who? What news is coming that we don't know about? You know? Like, where's the headline? Like, who is insider trading this sell news that we have not gotten the memo on?
Ever government shutdown. The risk-on bid lifting tech shares, really driving the rally in equities after the tech sector had been hit the hardest in recent days. Also coming up, we're going to discuss what to expect from tech and media earnings throughout the hour. CoreWeave's results are expected to raise issues about AI spending. After last week's sell-off, CoreWeave up 1.2% right now, this after a week where it was down 22%. This is also on the heels of other spending by tech companies like Meta and Microsoft. Also, Paramount Skydance down about 0.3% ahead of earnings. They're expected to report higher revenue and profit. Investors also.
All right, boring.
Influences how I think about the economy.
So how are you thinking about the economy without the official data releases? We're trying to track all the alternative data. And
I'm going to listen while I hit the restroom and we'll talk about it.
what are you seeing?
Yeah, so absolutely, it would be better to have more data than less data. That's absolutely something that would be the case. Nevertheless, we do have some data. And I think if you look at what's happened in the last few months, you go back to the September meeting of the Federal Open Market Committee, the median participant in that summary of economic projections was projecting a 3 cuts this year. So a cut in September, a cut in October, and a cut in December. What's happened since that happened, since we put those projections out? Well, we've gotten new inflation data, which were better than expected, which would make one think that it would be reasonable to be incrementally more dovish than at the September FOMC, where, again, the median projection was for 3 cuts. And on top of that, labor market data have come out with with the labor market continuing in the trajectory it was on, which is one of gradual softening. We do have some data on openings, on new openings that are available. We have some data on wages, and we have some data on jobless claims, and all of those are consistent with continued incremental softer weakening. So I would think the reasonable thing to be is incrementally more dovish than we were in the September FOMC, which again indicated 3 cuts for the
But
year.
your colleagues are not. And we didn't get that message from Fed Chair Powell at the last meeting when it came to guidance, and we're not getting it necessarily from the comments. They're still saying inflation is stubbornly high, and we don't have really enough data to tell us what to do.
Yeah, so I think that a lot of that focus is on inflation data that are, in my opinion, somewhat misleading. And so the question is, how backward-looking are those inflation data? And I think a lot of them are reliant on data that are, I think, at this point, quite stale. And when you look forward through things, I think the indications are for it to be actually coming down quite reasonably at a quite reasonable pace. And so one of the issues in the inflation data is that there's a lot of what we call imputed prices. These are not prices that are observed in actual transactions that households are engaging in. They're imputed. And the biggest one, of course, is housing through what we call owner's equivalent rent. But there's other ones, too, things like financial services, things like nonprofit services that are ultimately consumed by households. And when you look through all of these imputed prices, you look at a market-based core measure of PCE, it's running much closer to the Fed's target than the headline core, than the normal core PCE is. And then when you look at market-based PCE X, something like shelter, it's running just at the Fed's target. And so I think that a lot of the reliance on inflation data is actually quite backward-looking in the way that some of my colleagues are using it. And I think it's more important.
Yeah, but the trueflation, that's the argument we were just seeing, is that trueflation is actually leading, right?
Next week, if the shutdown actually ends, what's the first thing you're going to look for?
Well, I don't know if we'll be getting updated inflation data immediately. It might take some more time for that. I mean, we have the September CPI, and so we'll be getting following PCE data, but that's not that much incremental new information. To get new inflation data that's more recent than September will be a while. We will get the labor market data, but at this point it'll be somewhat stale. So I think it's going to take some time until we have new data that's actually changing the forecast. And again, policy should be forward-looking. So the question is, what has happened that would make you think that your forecast has changed based on where it was previously? And in my opinion, there's been nothing that's occurred since the September FOMC that would indicate a change of forecast.
Are you looking, speaking of looking forward, hopeful that tax refund season, OBBBA, depreciation will feed Q1?
Big beautiful bill, Q1. This is the Q1 argument.
Yeah, so I do think that some of those elements will feed into better economic performance next year as we go into the turn of the year. However, I think it's important for monetary policy to be thinking of not just economic growth as one number, but as an output gap. And so the question is potential GDP increasing more or less than actual GDP is? And when I think of some of the policies that have been enacted over the course of the year, in my mind, they're pushing out potential either by as much as actual is in the case of, I think, the tax law, or they're pushing out potential GDP by more in the case of deregulation. And so some of those policies actually make the output gap actually more negative and increase the need to cut rates.
So you favor, another 50 basis point cut in December? That's what you wanted the last two meetings?
Well, look, nothing is certain. We could get data that would make me change my mind between now and then. But failing new information that's made me update my forecasts looking out in time, yeah, I would think that 50 is appropriate, as I have in the past, but at a minimum 25.
So why are your colleagues, I mean, you mentioned the inflation story, that you disagree, that you think it's backward looking. They're also, Fed President Schmidt, who was a dissenter, and the other way, didn't want to cut rates last time. In his dissent, when he came up, we pulled up the quote, we can pull it up again. He was saying the economy is doing quite well. Unemployment is low. Stocks are near record highs. Credit spreads are near record narrow. So what is telling you there that the economy is restrictive? Here we go. Modestly restrictive, he says. Financial market conditions appear to be easy across many metrics, as I just said. The equities, the corporate bond spreads, high yield bond issuance is high. None of this suggests, he says, that the financial conditions are particularly tight or that the stance of policy is restrictive.
Yeah, but remember, financial conditions tightness is so based on the stock market. So it looks loose when the stock market's high.
Maximum employment and for stable prices. And financial conditions are a tool through which we work to achieve those goals. But even that said, I look at financial conditions, I don't see the same thing. Sure, there are parts of financial conditions where they seem quite loose, and you can sort of look at valuations in some equity markets or credit markets. But there are other markets where they appear quite tight. You look at something like housing, and I think that it looks like financial conditions are quite tight. And when I think what matters more for economic growth, and therefore for the labor market and for our price mandate, it's absolutely going to be housing relative to equity markets any day of the week. And on top of that, you see stresses emerging in some private credit markets. Those aren't going into the price indices that he's looking at when he's quoting something like that. So I think the situation is much more nuanced.
Dude, good answer, Myron. That was a badass answer. It's not because it's exactly what I started by saying, but it's like he's going even further. This is great.
Softening in the labor market.
He's saying housing and private credit financial conditions matter much more.
And you extrapolate continuing declines in inflation based on the catch-up of shelter inflation to actual market rents, which are very, very, very low, and based on ignoring some of the fake inflation and the imputed prices like portfolio management fees, it seems to me like we're heading a situation in which inflation is going to be coming down quickly, the labor market is continuing to soften.
Some people are still worried that the tariff inflation hasn't fully showed up yet.
People have been worried about that all year long, and they've been marking
their... That's still, even if you say inflation is backward-looking, they say, okay, well, there are risks to the upside going forward.
They've been marking their forecasts for tariff inflation down all year long. People have been moving in my direction on tariff inflation all year long. And on top of that, if tariff inflation does materialize, it is the definition of the type of thing that the central bank should look through. If tariff inflation were to materialize, it is the kind of one-off, fiscally driven price increase that is not indicative of underlying changes in supply and demand, right? You worry about second-round effects if demand is outstripping supply, and therefore there's going to be persistent upward pressures on prices. prices. If prices move higher because there's a fiscally mandated price change, whether it's a tariff or a value-added tax or something that happens in healthcare or whatever it is, that's not the type of thing that gives rise to persistent demand outstripping supply that would cause persistent inflation effects. It's the definition of the one-off that the central bank should look through if it were to materialize.
Waller's argued that too.
You mentioned private credit. Do you
Powell has mentioned that himself too. Let's hear the private credit card argument.
I do consider it a large known unknown. That's exactly the right way to describe it, I think. It's something out there that we have limited insight into, right? There's less transparency in a private market than there is in a public market. But we don't know how much of the issue, if at all, it is. I'm not negatively, sort of disposed to private credit just because it's private. But I do think I don't know as much about it as I do about some public markets. And I also think that we need to be thinking about this when we think about financial conditions in the way I described before.
And when it comes to like short-term Fed liquidity, are you a fan of maybe continue to inject money overnight and moving to a QE stance as opposed to QT?
You mean in terms of expanding reserve balances?
Yep.
Well, I think that's a separate question from the stance of monetary policy, right? So first, let's back up a second and examine what we did at the last meeting. We stopped allowing the maturing mortgage-backed securities to roll off our balance sheet in a way that would decrease the amount of reserves in the system. So now when a mortgage matures, we replace it up to the cap. We replace it with treasury bills. So the overall size of the balance sheet doesn't change. However, that's still an increase in net supply of interest rate risk, of duration risk, and of credit risk into the economy, because that maturing mortgage, when it's replaced by a new mortgage because the person moves or refinances, that has to be absorbed by the market. And so the restrictive stance of balance sheet policy hasn't changed, even though we're keeping the amount of reserves constant. So that's the first thing to note.
Right.
The second thing to note is that if we do end up increasing the size of the balance sheet for the sake of keeping reserves in the system, which is not a monetary policy issue, it's a banking issue and regulatory issue. If we do that, and we do it by buying treasury bills, we create reserves in exchange for these treasury bills, that's basically swapping one form of short-term obligation for another form of short-term obligation. Unless you expand the balance sheet in a way that you're buying longer-term debt, whether it's mortgages or treasury securities, it doesn't have an implication for monetary policy.
The other thing that's happening is we're seeing this inequality rise.
Basically saying, in other words, the treasury bills buying doesn't really matter.
First, we saw it in the consumer confidence data that we got on Friday.
Yeah.
And I think the strongest argument for doves like you is that we don't make monetary policy for the markets and for the top percent. And what we're seeing in terms of strain.
Gotta love the double coffee there.
On housing, affordability, not participating in the market gains, that, I think, is the best case for cutting interest rates. I mean, do you see that gap widening?
Yeah, look, we also weren't tasked with tackling, inequality and other items like that. We were tasked with maximum employment and stable prices. We're no longer at maximum employment because the unemployment rate has been drifting higher over the course of the last 12 plus months, right? And it continues, in my mind, to drift higher. So we're no longer at that. We're drifting farther away from it as we allow the labor market to continue softening because policy is too tight. And so it's imperative upon us to adjust policy, to continue calibrating it downwards, to prevent that restriction on the economy from bringing the unemployment rate even higher.
Sure. I mean, I think those two arguments go together actually quite nicely. There is, though, this argument. I'm just going to throw all the counter arguments at you. What is the rush? What is the urgency? Why don't we wait till we get a clearer sense of the economy and inflation? Nothing is screaming like the Fed needs to be.
This is a good question. Let's see what he says to this. This is a great setup by Sarah.
It's a great question, and it ties back to what we were talking about before with the lack of data. So monetary policy works with lags. If you adjust interest rates now, it doesn't hit the economy now. It takes a while to hit the economy. Nobody knows exactly how long those lags are. Most people think probably 12 to 18 months. Some people think they've shortened a little bit relative to that recently. However, if you're making policy for what the data are now, you are backward looking because it will take 12 to 18 months for that to hit the economy. So you need to make policy now based on where you think the economy is going to be a year to a year and a half from now. And if you say something like everything seems fine today, or we don't have data and therefore we're in fog and we need to sort of just sit still, you're making policy in an extremely backward looking manner. And I think that's very dangerous because you're not responding to where the economy will be 12 to 18 months from now.
But nobody knows. No, we don't know the impact of AI on the labor market,
I mean, that's
for
true,
instance.
though, because then if you cut now, you could overstimulate in the future.
The Fed's own forecasts every time they forecast GDP and inflation are wrong.
Yeah, so uncertainty is part of the human condition. We will never live in a world with perfect certainty. We do live in a world with forecasts, and it is incumbent upon us to make policy based upon those forecasts for the future, not to make policy based on what the data are today or what the data were 6 months ago, which is what you're doing if you're saying we need to just sort of stop and not do anything because we don't have all the information we need. We will never have all the information we need. That will never be the case. So the question is, with the information available today, what does that do to our forecasts 12 to 18 months from now? Did we get information that would make us think that our forecasts 12 to 18 months from now were wrong? In September, we put out projections. What have we learned in the meantime that would tell us that those projections had moved up or down? As I said before, we got an inflation print that was better than people expected, which should make us move our projections somewhat down in terms of interest rates, and we got continued labor market softening that was in line with what the expectations were, which again should tell you staying the path is the right move.
So you think the market's coming to you, or consensus is coming to you?
I do, and I think that's been the case all year. I think that earlier in the year I was out there saying that I didn't think that tariffs were going to cause some sort of big recession or massive inflation spike, and there absolutely were very, very prominent people, very serious, well-respected people, saying that tariffs were going to cause an inflation spike, like we had after COVID, or saying that tariffs were going to cause a recession or whatever it was. And I think people have been very gradually moving in my direction on those things.
So the market's at what, 64% odds of a cut in December?
Yeah.
Do you think the Fed ultimately will cut in December?
Well, again,
I know you want them to.
Look, I can only speak for myself, right? However, as I said before, I think if you took the September projections seriously, what is the information we've gotten since September? And I think it all points in one direction. I don't think we've gotten any meaningful information since the September FOMC when we put those projections out that would have told you that actually it's time to sort of reverse course and take a cut out from this year. I don't think we've gotten any information.
So why did Powell cast doubt on that in the last meeting?
Yeah, so again, I can only speak for myself, but I've always thought of the chairman's job as reflecting the views of the committee. And, I don't think it's a secret that the committee is somewhat divided right now. And so the question is, where are the votes going to shake out over time? I think, as I've done before, I think it's appropriate to quote former Speaker Pelosi, Nancy Pelosi, who one of her favorite lines was always that the vote is the currency of the realm. And so the question is, how are things going to shake out when we get to December?
Well, it's going to be interesting to be inside that Fed meeting, a particularly divided Fed. Thank you for coming on and sharing some of your views.
Thanks for having me.
Always good to hear from you. Fed Governor Stephen.
I mean, I think he's got a good point. And it just shows you that duality of where we sit right now. And I think we can break all this down. And obviously it comes at this wild time where now, there's this talk about potentially these stimulus checks again. So you're really in this bizarre teeter-totter economy. We just don't know which way it's going to break. That's why I've been so mid-range on the bear bull scale. It's crazy. I mean, let's look at some of the consumer stocks right now. Let's put up, Target. Here, I'll go to the day chart. There's Target. Well, how's Cheesecake doing? Cheesecake. Restoration Hardware. Another one, Dave & Buster's. How's Simon Property Group? Be curious about that. Wow, dude, that's a short. You gotta be kidding me. Oh, man. Holy smokes, why? Oh, that could be an interesting short. Just because all the other consumer plays are down, but so all the components, how is Macy's then? Wow, Macy's is at all-time highs as well. That's interesting. How are the malls, the mall-related, like Macy's and Simon Property at these high levels, but then these consumer stocks so whacked? That's fascinating. Like Fun's another one. Trek Stacking is another one. Then you've got, let's see some other ones. Just consumer ones. We're going to look for consumer, like Etsy or Pins. Put those up here. Etsy, Pins. These haven't exactly been the greatest stocks. S-Bucks is another good one. S-Bucks. Let's see here. How's Best Buy and UPS? Best Buy? I mean, UPS's downtrend is just depressing. UPS? Yeah, so you've got a little bit of a mix, but certainly some pain in that consumer. Lay off 20% of your employees and your stock goes up 25%? Yeah, no kidding, huh? Oh, it's just a twisted world. All right. We should, let's see here. Let's see. BBC, we saw that. Reeves, we saw that. I saw this. Okay, just checking to make sure we're not, like, missing anything new here. I don't think we are. Just check over here. Shutdown talk. 10K bonus for staying on the job at air traffic control. Okay. That's not news. Let's go over here. Doomers. No, nothing really exciting here either. Okay, let's do a full breakdown of all of what we just heard. Try to explain it all. Put it all together. All right. All right. Well, this morning we have a lot to break down, including updates on the new $2,000 stimulus/dividend payments from Donald Trump, Bassett sending confusing signals about it, but then Trump reiterating them, along with what's the Fed trying to tell us about the economy, and you'll be shocked with how much certainty they're telling us what's actually going on in the economy. Then we'll also break down what's going on in private credit, because we just saw a nice big fat BlackRock write down on those Renovo home project loans, and so we'll talk about that. We broke down their complete collapse just a couple weeks ago following the First Brands and Tricolor collapse. All of it telling us at least something about what's going on in the economy. But first, let's start here. So Donald Trump just truthed the following: that all the money left over from the $2,000 payments made to low and middle income U.S. citizens from the massive tariff revenue pouring into the country from foreign countries will be substantial and will be used to substantially pay down the national debt. Thank you for your attention to this matter, President Donald J. Trump. Okay, now, why is he doing this? Well, one of the reasons he's doing this is because the Wall Street Journal editorial board just lambasted Donald Trump's plan yesterday evening. So yesterday evening, the Wall Street Journal editorial board basically said that Donald Trump was looking for a Hail Mary to gain popularity again, going as far as calling people fools who are against tariffs and saying that we're going to pay down the national debt. Wall Street Journal editorial board says that this is a logical fallacy to argue that you could both pay down the national debt and issue stimulus checks when we're literally running an annual federal budget deficit of $1.8 trillion per year. So no, like, if you just spend one extra dime, you're just deficit spending, because we are literally increasing our debt by $1.8 trillion per year. So the only way you could pay down the debt is if you just essentially take 100% of tariff revenue and apply it to the debt, and you're still growing the debt because we have such an unbalanced budget in the government. And then, of course, the Wall Street Journal goes as far as saying, hey, like, if people are so happy about tariffs and everybody loves tariffs, then do we really need a tariff dividend check to be happy about tariffs? And I think the Wall Street Journal is going a little off the rails here because, in fairness, people are suffering. Like, grocery prices, rent prices, energy prices, home electricity prices, all this stuff is through the roof. And that's what people are frustrated about, and people are looking for relief. So I don't think that the idea here is that maybe people don't like tariffs and therefore they need to be coaxed into liking tariffs with a check. I think people are like, yo, I'm pissed, I'm struggling out here, and I need a little bit of help. That said, the Wall Street Journal does have a fair point, saying that we got a lot of debt. We're not paying down the debt and doing stimulus checks. So Donald Trump announces these $2,000 stimulus dividend or tariff dividend checks. Wall Street Journal bags on him. At the same time, Scott Besson is like, well, you know, you could measure that $2,000 in many different ways. It doesn't actually have to be a check, which is this clip here.
You know, it could. The $2,000 dividend could come in lots of forms, in lots of ways, George. You know, it could be just the tax decreases that we are seeing on the president's agenda. You know, no tax on tips, no tax on overtime, no tax on Social Security, deductibility of auto loans. So, you know, those are substantial deductions that, you know, are being financed in the tax bill.
So that then turned around and pissed a lot of people off because people were like, wait, are you like lying to us? Like on one hand, you're like, hey, we're going to send these $2,000 checks. And then the Wall Street Journal bags on you. Then all of a sudden, Scott Besson walks back to the idea of $2,000 checks. And then all of a sudden, Trump is like, that's all wrong. We're definitely going to take the $2,000 payments and send them to citizens. And we're going to pay off the debt. Again, the Wall Street Journal still has a point because we're in such a deficit hole that we're definitely not going to be paying off any debt. We're still going to be adding to the debt by paying the checks. But Donald Trump, at the very least, is doubling down on making the payments. In addition to Trump doubling down on making $2,000 payments, he's also now promising that he wants to recommend a bonus of $10,000 per person, like air traffic controller, who did not take time off during the government shutdown. Because obviously when people stop getting paid, they get told like, hey, like you're not getting paid, you know, you're supposed to show up to work, but if you don't, like, I don't fault you. But then there are some people who are like, no, man, you know, my mission is showing up every day and trying to keep America operating. And they show up to work. And Trump is like, hey, we want to reward those people. Now, one of the reasons Donald Trump is doing this sort of like, hey, let me throw cash at people, whether it's $2,000 to low and middle income individuals, and throw money at air traffic controllers who are working for their living every single day, is probably because of what The Economist says. The Economist just did this great breakdown of 4 groups that used to support Donald Trump that are all of a sudden lacking based on the last election. Those are Arab Americans, Hispanic Americans, younger Americans, and women. So these are groups that were all voting for Donald Trump when he was running against Kamala Harris. But now all of a sudden you're seeing these minority communities and these other groups tilting back towards Democrats, and those margins are getting flipped towards the Democratic side. See, both count, and they go granular here, and I'm going to give you the summary of it. But basically, they go very granular. They say counties with large Hispanic populations were groups that Trump previously wooed, but that's now being flipped over, right? So now all of a sudden, what you have is Trump a little bit freaking out, going, hey, you know, we need rate cuts at the Fed, and we need to really help out the people that we're now losing, so let's offer them money before midterms so we don't get shellacked in midterms. The problem, of course, with this is at the same time as Trump is hoping for this, you also have a Federal Reserve that's extremely confused with what the hell they want to do. And it a lot relates to what Academy Securities is talking about regarding interest rate hikes. Now, this is quite interesting. So Academy Securities put out a piece, and they argue that, look, if we actually looked at 2021 and 2022 when we were printing stimulus checks, we saw true-flation skyrocket. The problem with true-flation skyrocketing is it's an underused guide for what's happening with inflation because the Fed likes to use CPI, but CPI lags massively. So what a surprise, we were about a year late on inflation because it lagged massively when the Fed uses CPI as a core component of PCE, which is their preferred gauge. And then all of a sudden the Fed's late to raise rates. If they listen to true-flation, no problem. Well, what's happening with true-flation now is we're slowly starting to see a little bit of an uptick. In fact, the writer here at Academy Securities says true-flation is creeping back above 2.5%. Now, that extra 0.5% may be entirely because of tariffs, so it could be Trump's own doing. But here, you've got Academy Securities warning that we've got to be worried about inflation going back up. And there's actually an argument for higher yields instead of lower yields in the near term. Now, of course, there's plenty of data suggesting that the economy is weakening, but this is where you're getting this debate at a really sensitive time for the economy between Fed officials. And it's creating a lot of problems. And I'm going to break down what some of those problems look like, and then I want to break down what the Fed is saying here because you could see the confusion. But understand the problems here. So on one hand, so these are going to be like, negative supports, okay? Negative supports are tariffs because obviously they're going to at least create a risk of perpetual inflation. They create, as we hear, it's one-time inflation. One-time inflation effects, though, can create perpetual inflation threats. So therefore, tariffs hurt. But also a negative support for cutting rates, so I'll say for cutting. Another negative support for cutting is issuing a $2,000 stimulus check, right? Those won't actually encourage the Federal Reserve to cut because they're both going to be inflationary issues. But at the same time, positive supports for cutting are obviously what we're seeing in the highest layoff announcements year to date. And in a Q4, in over 15 years, right? Going back to the Great Recession, which isn't great. So layoffs aren't doing very well. The ADP 3-month trend is basically zero for job gains. We have job cut announcements, like to come, right? To be like job cut announcement plans, they're called job cut plans. Plan announcements. There we go. Plan announcements. Those are the highest since 2008. That's not good either, right? Because it's not just the layoffs that have been announced, but the fact that companies are saying, yeah, we're planning to announce layoffs. In the last ADP report, we saw those were at 450 announcements. That's the highest level of announcements that we've seen, especially going into the holiday season in quite a while. So these are positive supports for cutting in addition to what we're seeing with, the K-shaped recovery, right? So K-shaped recovery of stock investors and wealthy investors doing well with spending. But the problem is that doing well with spending isn't ubiquitously felt for everybody. That's why so many people are clamoring for some form of relief, like a $2,000 stimulus check. It makes sense. But look at what the Fed, here, let me tell you what the Federal Reserve talked about today, and this is where you're getting this division. On one hand, you've got Mr. Muslim, who is saying that, hey, rate cuts that we've made were insurance for the labor market, and we're going to see a boom in the first quarter of 2026 because you're going to see a combination of rate cuts, deregulation, and the government spending money again as the government reopens. The labor market's been cooling down, but it's all orderly. Everything's fine. So if you literally got one guy at the Fed going, hey guys, everything's fine. Like, it's good. We're going to go back to the moon next year, which is great. A lot of people, especially in the stock market, want to hear that because you want to keep making money. And you have other people at the Fed like this as well, like Schmidt, who's like, dude, we don't even need to cut rates anymore. This is why a rate cut in December is basically a coin toss right now. It's sitting at 63%. 63% odds of a rate cut in December is like, we don't know. We're 50-50 on whether we're going to get a rate cut or not. Daly this morning spoke. She says the tariff effects so far have been contained to goods. Okay, well, remember how I said that risk of perpetual inflation? The risk of perpetual inflation is as soon as the tariff effects get uncontained from goods. That's why she's saying it, because she's like, hey, so far we're good. Hopefully it stays that way. As soon as it spills over, you get a problem. It's hard to put the inflation genie back in the bottle, as people say. So this is why people are like, I don't know. Should we be cutting right now? And then, of course, you get Myron. Myron's like, hey, Fed policy really lags. Now, this is the Trump shill, but he's also pretty good. I like him. So he says, if you look at financial conditions and private credit and housing, you have a whole host of issues that suggest we should be cutting maybe even 50 basis points in December, at minimum 25. The labor market data we have so far is stale, but everything we have so far is saying we should be cutting. And yeah, of course, is there a risk of overstimulating in 12 to 18 months? His argument is, listen, if you're making policy using today's data, you're looking backwards 12 to 18 months. You got to make policy based on where we're going. And the trend is falling employment, softer ADP, higher layoffs, and more layoff announcements coming. That is the trend. He's right about that. So it probably makes sense for the Federal Reserve to cut. But the problem is Donald Trump is kind of shooting this potential for rate cuts in his own foot. Like, Trump wants the rate cuts. But tariffs make rate cuts harder because they create this uncertainty around perpetual inflation. And then, of course, stimulus checks also create a risk of substantially more inflation, which again then says, well, maybe the Fed shouldn't cut. So Trump's policies don't really align with encouraging the Fed to cut, even though Donald Trump is demanding the Fed cut. Now, Myron also talks about private credit, which is a big deal. I mean, BlackRock, listen to this. This is crazy. A month ago, BlackRock deemed the private credit it had extended to Renovo Home Partners, a struggling home improvement company, to be worth 100 cents on the dollar. As of last week, the firm had a new assessment. It's actually worth 0. I mean, this is literally like the South Park meme, where you go into the bank and you go, hey man, how much is my $100 worth right now? $100. And then it's gone. What do you mean it's gone? It's gone. All of it. It's gone. In fact, you can't even sit here anymore because this seat is only for customers of the bank. And because you don't have any money, you're not a customer anymore, so leave. That's scary. Now, then again, I'm a little bit skeptical on how bad this private credit issue really is, because it turns out that, you remember the whole tricolor collapse that we covered on the channel? You know, they were giving loans to undocumented immigrants in Texas, and this was probably not a surprise that when the border got shut down and you know, new loans dried up and other people were getting deported, it's probably not a surprise that all of a sudden Tricolor went bankrupt. Well, apparently they were actually they flagged by this company called Waterfall Asset Management. And what's interesting is if Waterfall Asset Management reported them, and they just took on another 750 million pounds of funding, basically, bringing the new total of funding to 3 billion pounds. It doesn't seem like they're actually terribly worried about private credit. But then what did they do to Tricolor? Well, what happened was Waterfall Asset Management, per Bloomberg, Waterfall Asset Management actually called up JP Morgan and said, hey, we think something sus is going on over here at Tricolor. JP Morgan then calls them up, the CEO, and then very rapidly rug pulls their warehouse line of credit. And then, wow, what a surprise, the company collapses. So it's really interesting because, like, what we heard, right? So we heard Tricolor collapsed. Jamie Dimon says there are cockroaches. You know, and then all of a sudden, Renovo collapses. Oh my gosh, Jamie must be right. Right? That's what we heard. That's what we were told, like in the public. You know, us peasants in the public compared to the suits who have all the insights. But what actually happened, which is so interesting because it's sort of like expectation versus reality. But anyway, what actually happened is you actually saw Tricolor gets thrown under the bus by Waterfall, who's borrowing like crazy in private credit. You know, so it's like they haven't slowed down at all. They just throw Tricolor under the bus. JP Morgan rug pulls the Tricolor warehouse line of credit. This is why I've been warning, like, you got to be careful with these big banks, right? Like, they will rug pull you and not even care. And then, you know, we see Jamie Dimon, you know, come out about cockroaches. But he's actually part of the reason that this Tricolor collapse happened. Because, sure, like, either is possible, right? It's possible Tricolor was a fraud, or it's possible they got thrown under the bus. Maybe they weren't a fraud, and JP Morgan just got a little, you know, scared for whatever reason and just rug pulled them. It kind of makes you nervous about having debt with JP Morgan. Now, it's funny, I was mentioning this morning in the course member live stream in the Alpha Report, but, you know, people make this quote or circulate this quote on mostly on X and stuff like that. They say things like this: if you borrow $100 million, or sorry, if you borrow $500,000, let's call it, the bank owns you, right? People make this quote all the time. And then they say, if you borrow $100 million, you own the bank. And then I follow this up and go, no. When JP Morgan has over $1.4 trillion in assets, $100 million is literally like you having $250,000 in a bank account and your child asks you for $17.85 for their book club. In other words, JP Morgan doesn't give a flying crap about your $100 million. It's pennies to them. So JP Morgan will be more than happy to rug pull you, whether or not any of the allegations are founded or not. So it kind of makes me wonder, like, is there really a private credit issue? Or is this just JP Morgan being the jerks that JP Morgan is? They go around rug pull people. I don't know. The lesson to me is you got to be really cautious trusting the big banks, because they can rug pull you at any time. I don't think we hate the big banks enough. Now, don't get me wrong. I do think there are risks with these private credit rating agencies. You know, Financial Times has this whole piece today about like this growing risk of Morningstar or Kroll or HR Ratings or Egan & Jones. Basically, these companies issuing private credit letters that are not publicly disclosed. And it's like, hey, they could all be bad. I agree they could all be bad, because you have to understand how private credit really works, like these ratings. If you go shop them up and you go call them and go, hey, we're looking to get a rating on this pile of shit, basically. We're looking to get a rating on this. You know, how much are you going to charge? How much are you going to charge? How much are you going to charge? Like, on the phone, some of these companies are going to be like, hey, man, we might be a little more expensive, but we'll get you that AAA. You know, like, we don't know that's happening for sure, but we could guess that's happening because these rating agencies, they don't really care if the loans go bad, because it'll just be like a whole systemic shock and crisis, and how could anybody have known, whatever. They want their money now, baby. So if you try to put all of this together, you're in a really teeter-totter position in the economy. This is why, you know, if you go to meetkevin.com/data, this is free, okay? You go to meetkevin.com/data, I put the bear bull scale. And so I update this every so often. It's, by the way, also where you could sign up if you want for the totally free daily wealth email. If you put your email in here, we'll send you that daily wealth email all the time. I also have the taco scale for Trump, you know, always chickens out score. But anyway, which has been very supportive for the market so far. But I mean, like, if you put all of this together, it's really hard to say, oh, we should be 10 out of 10 bullish. And it's also really hard to say we should be 1 out of 10 bearish, right? Because think about it. You have true evidence that says, yeah, there are really actually inflationary effects in the economy. You know, stimulus checks are inflationary. Tariffs are at least short-term inflationary. And those could become perpetual inflationary issues. Okay? Then on the flip side, you got all this jobs data that basically says our jobs market is utterly collapsing and the consumer is completely destroyed. You know, but then you have people like Muslim over at the Fed who are like, oh, but financial conditions are you know, very, very loose. Like, this is very supportive. But then Myron counters and says, yeah, but that's because you're looking at stock valuations, which are at all-time highs. So if you take the peg leg of the stock market away, you got really tight financial conditions. Overnight, you could have really tight financial conditions, which is really bad because it, you know, could lead to a lot of pain very rapidly. So that's the teeter that you're on. On one hand, you got a really seriously slowing down labor market. You know, people don't pay attention to this as much as they should. But remember what I broke down in that ADP report. The ADP report was above trend. That was fantastic. It was above that 3-month trend we wanted. Nick T pointed that out. I've been pointing that out. This was great. The 3-month trend stayed positive. The break-even labor report is probably closer to 0 to 20. We got 40. That's great. But the concentration was what nobody paid attention to, that it was basically just West Coast. Well, what happens when all of a sudden that West Coast hiring stops? Now labor falls off a cliff. Then financial conditions tighten. at the same time as you have lingering inflation, because then almost certainly you're going to get your stimulus checks of $2,000, because if the economy goes into recession, Trump's just going to print money. That's going to be his goal. He's going to print checks. So debt's going to go through the roof even more, but stock values then collapse. So you have this insane position you're in the economy right now. And it's so hard to say which way are we going to blow. Like, the wind can blow in one direction and that's it. Labor recession or Q1 boom. Everything's skyrocketing again and everybody's hiring again. It's all going to be predicated on hiring again and us not, tipping over. But put all of this together. Man, this is a very, 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 very bizarre place to be in. And so it makes sense why people are like, I don't know, are we going to get a rate cut in December or not? It makes sense why you got half Fed members going, we want the rate cut, and the other half going, that we don't want the rate cut. Because nobody freaking knows. And that's why I like my point of view and my bottom line recommendation, which obviously isn't personalized financial advice for you because I don't know your situation, but my personal bottom line recommendation when you're in this sort of crap environment where we could blow either way, where the Bears are right or the Bulls are right, the best thing to do in that sort of middle ground is get the hell out of debt. Because as much as you can, okay, top priority number one, no margin debt. Get rid of these lines of credit that the banks could rug pull you on. Like, imagine this. Imagine you just took out a $500,000 home equity line of credit. You put it all in the stock market. You put it all into Tesla stock at 450. Okay? Then we get a bad jobs report or whatever. Tesla goes to 200. Now your 500 grand is 250. And then JP Morgan, because they're scumbags and you should never trust this bank, calls you up and goes, hey, bitch, guess what? You owe me 500 grand back right now. And you're like, what are you talking about? It's a 10-year home equity line of credit. And I thought I was able to pay this back over 30 years after it goes into the amortization period. And they're like, yeah, bro, read the fine print. We could call it at any time. I mean, I don't know if your loan says that, but you just got to be careful. Certainly that's true on margin loans. So apparently it's true on what's it called? These warehouse lines of credit for businesses. That's exactly what they did to Tricolor, and that's why they went BK. Or at least contributed to it. Who knows? Maybe they were a fraud too. I don't know. And then, this is the same thing that when I bought my plane, they tried to do to me. And I'm like, hell no, I'm going to fall for that. See, when I bought my plane, I got a plane loan at another lender that was a 20-year fixed rate loan, no margin provision. Like, you can't margin call it. It's 20-year fixed rate. You make your payment every month, you pay it off. Doesn't matter what the value of the asset is. JP Morgan is like, oh, we want an annual right to remargin, which means every single year they can have their own opinion of value and then go, yeah, now we want an extra $2 million out of the blue. And then what? You got to raise money when the stock market, it's insane. I think JP Morgan just sort of like rests on their laurels of the name of being big or whatever, but that's all it takes for the banks to, like, imagine when the banks start rug pulling more businesses. Jeez, I hope they don't. But that's why I try to stress that to my audience, to you, whether you're a course member or you're not. Like, I appreciate you watching me, and I just don't think that people caution enough how dangerous these margin loans are, because all it takes is the DTCC changing collateral requirements and all the broker dealers, M1 Finance, Robinhood, all of them calling you up and going, hey, you used to borrow up to this much on Tesla, now you can only borrow a fraction as much. And then you get rug pulled. And that can happen overnight. And it always happens at the worst time. So that's it. That's it. That's my take. Now, hey, we got an update on the checks, but ironically, the checks pressure inflation, which probably gives the Fed even more pause. It's a bizarro environment. I can't handle it. Anyway, so hopefully that's insightful. That's my distillation of the insanity that's going on right now. And then there's Sarah.
Alternative asset manager to reignite Burger King's growth in China. The goal is to grow Burger King China to over 4,000 restaurants by 2035.
Grow the burgers.
Joining us here first on CNBC is Restaurant Brands International Executive Chair Patrick Doyle. It's good to have you back.
Honestly, I don't
Welcome,
really care
Patrick.
about
Nice to see you. So what?
All right, what's going on over here?
be able to move quickly, turn our reactors on, safely test them before we go and scale.
You know, Palmer, we were showing an image there of different investors in the company, Palmer Luckey of Anduril, among those investors, certainly thinking about the defense space and his involvement there. What are the applications of your technology when it comes to defense for the United States?
That's exactly right. You know, American military bases all around the world are generally dependent on their local grid for power. This has become a massive vulnerability as grids have become vulnerable to cyber attack, you know, by our competitors. And so this is a way for us to actually secure American military bases abroad. We want to see these reactors deployed on bases. A couple of months ago, the Janus program was announced under the U.S. Army to do exactly this, to actually put power on military bases that's fully within American control. And we think these reactors are perfect for that. This is a nice small form factor that's very easy to construct and is powerful enough to power a base if you put a couple of them together. So this is a really exciting opportunity, and we're willing to help our country in that way.
We've seen American...
You know, I like the line, this is Schrodinger's economy. We are either alive or dead, or both. Kevin, what are your thoughts on the Texas Stock Exchange? Who cares? Like, I appreciate you donating $5, but why do I give a flying hootie doody about a new stock exchange? What difference does it make? When you go buy a stock, do you look to see if it's listed on NASDAQ or New York Stock Exchange? Do you know where Apple is listed? Do you know where Microsoft is listed? Do you know where Home Depot is listed? Do you know where Disney is listed? Do you care? I don't think that matters at all. Yeah, I mean, who knows? Maybe they can do some more ETF listings or whatever, but I mean, you got like millions of ETF, or thousands of ETFs already, so I don't know if that matters. Sorry. I don't know why. Like, I appreciate the $5, but like, I don't understand why I would care.
For the industry. Yeah.
Yeah, a little over 3% with Burger King. And, you know, look, it's been getting better. Our teams are executing at a high level. Tim's was great. Our international business was fantastic in the third quarter. So, you know, it's been a little bit choppy out there, and we certainly saw a bit of that in October. But, you know, I think as the government shutdown, all of those sorts of things starts to give a little bit more consumer confidence, I think we're going to see.
I don't, you know, I'm still bearish on like when the data starts coming out. That's the part that drives me nuts. Yeah, dude, I got all these mosquito bites. Damn Mexico with the mosquitoes! What is this crap? Sorry. But I think I got so many bites. And I keep scratching them, and then I get to bleeding, and it's like, oh my gosh, get the venom out. Anyway. All right.
In the last year than we've seen in a long time. And a lot of it has to do with, are they getting the value equation right? Have they taken too much price over time? And are they just executing well on the fundamentals? And I think you're seeing, you know, a big bifurcation. People who are executing well are getting great results. And there are folks that I think have been struggling to do that. And if they also took too much price, over the last few years, then consumers are turning away from them. But our team's doing a great job on it. I think we're in a very good place.
What do you do, though, if your commodity inflation's running high, single digit? I mean, if you're heavily exposed to beef, I mean, how good can execution be?
Boring.
Yeah, you got to take some
Something wrong with the market and capitalism, and therefore...
What about the real estate around the Texas Stock Exchange? Come on, man. These exchanges are mostly electronic now. It's not like you're getting like so many jobs all of a sudden.
The real average average earnings have actually increased by 14% since the beginning of the pandemic. Rents have increased by 30%. Okay, so wages are not going up. Inflation is going up, and inflation is going up even more in places like New York City because of the rents. And so, yes, his appeal to this kind of populist, there's something wrong in the country, that we need to use government to solve our problems. Yeah, that did appeal to these young, miseducated, I shouldn't say overeducated, miseducated people.
Alicia, you're all right. Thanks very much indeed for joining us. We'll see you again real soon. It's that time. The Monday trivia question. Well, this is not a trick question, but it seems like it. When was the official end of World War I?
Oh, these trivia questions. All right, so let's see here. What else? So we covered a lot this morning. the funding stress we talked about. We talked about the Jamie Dimon rug pull. Let's see here. Qs. We had to move down on the Qs, which was kind of surprising. Just came out of nowhere. And what a weird time, right? Like usually we get the AM or PM dump. This came out of nowhere. Restaurant brands have completely ruined Tim Hortons after the acquisition, a collapse in quality and customer service after the buyout. Oh, wow. Yeah, that's interesting. I mean, I think that's often what happens is, private equity or big companies, they buy a brand and then they look for ways to squeeze out every dollar via efficiencies, quote unquote efficiencies. But then they end up destroying what made the brand in the first place, what gave it its reputation for quality and customer service. And then when you destroy that, you basically rug pull that reputation. Yeah, for a while you could get away with that. You could squeeze out the rest of the money. But it doesn't last forever. At some point, people start revolting, and then the brand dies. I feel like that's a story as old as anything. No? That kind of makes sense. All right. Somebody says, I used to love Tim Hortons. Their coffee became terrible. Their food items became worse. Adding terrible items. Low quality. Same as Canada Goose. Oh, quality sucks, but prices keep going up. It's exhausting. Senators take aim at Meta, OpenAI, Alphabet, Oracle, and Letter. Who cares? A lot of these people, they write letters that go absolutely nowhere because they're, promoted by lobbyists to push for short-term swings in stocks that they can end up insider trading. They get very jaded about that. It's kind of crazy. So, all right. Well, I think that's it. It's kind of straightforward today. So, yeah. Anyway, cool. Well, thanks for being here. I'm gonna go work on House Hack. Love y'all.